All right, so interesting thing. I want to talk about the market and kind of what I'm seeing and make sure that you guys are armed with all the information possible. Obviously, nobody can tell the future, what's going to happen, but there's some interesting things happening. I went back and looked at 2005, 2006 news articles about the real estate market, and if you have 20 minutes, it's really interesting how history tends to repeat itself. So here's one that I thought was interesting, speculation from August 27th of 2006. Now, 2005 was probably the high of the market, and around this time they were starting to question whether or not they might be in a bubble. Obviously, by this time, 2007, there was already significant changes happening in the real estate market. But a couple things in this article to note. Number of building permits falling, which is usually only seen in recessions. Fate of the housing market will influence whether the economy will merely slow over the next year, as the Federal Reserve forecasts, or fall into a recession for the first time since early 2001. Lehman Brothers said that for sale signs have replaced gas price signs as the most important indicator of potential trouble. The collapse of most bubbles does not have a single obvious starting point, like a bad corporate earnings report or an interest rate rise. Instead, the psychology of buyers and sellers shifts, slowly at first and then sometimes in a cascade. So, interesting that 2006, prior to the crash, they're talking about the psychology of buyers and sellers, which really just goes back to supply and demand, buyer sentiment, seller sentiment, which is all things that I think are at play in today's market. Seems to be three major paths that housing could follow over the next year: a soft landing, the start of a long slump, or a crash. Soft landing is the one that is predicted and preferred by most economists on Wall Street and the Fed. A long slump is what many past real estate booms turned into, and a crash is the outcome that a small group of analysts say is the only possible ending for the biggest housing boom of all. Prediction looks better than it did a few weeks ago, blah, blah, blah. Funny thing about bubbles is that you never know when they're over. For a crash to happen, prices would have to decline significantly. So far as sales have slowed, which is something we're seeing now, and the number of houses on the market has soared, which is not something we're seeing, many owners have chosen to sit tight, which is something we're seeing. So we've got two of these three things happening in today's market: sales dropping and owners sitting on the sidelines with inventory down, listings being down. If they were instead decide that selling later would be even worse than selling now, this could change quickly. So hold on to that. If they were to decide that selling later would be even worse than selling now, this could change quickly as people would get into the market. Affordability is something they talk about. Major metropolitan areas being difficult, which is something we're seeing now. In effect, families seem to be buying houses that they can't afford in the hope that their income or property values will rise significantly. Something we're seeing now. People stretch their price points as prices go up. If prices decline, some of the first victims would be family in a financial bind. Foreclosures would then rise. Foreclosures are up for the first time since 2016, I believe I saw in the headlines earlier this week, or late last week.
Right now?
Foreclosure rates have ticked up for the first time in a couple of years. Nationwide. So anything I'm talking about is nationwide stats. Housing slowdown has become damaging the job market. Builders, mortgage lenders, and real estate agencies have stopped adding to payrolls. Not so much as was seen back then, but we'll look at the housing. We'll look at the builder market here in a second. All right. Interest rates could play a role. They've been falling for much of the last decade, helping to push house prices higher by allowing buyers to afford bigger mortgages. This was in 2006. Most economists expect rates to remain lower than they were a generation ago, but not to return to the extremely low levels of a few years ago, making big swings in house prices in either direction unlikely. Obviously, rates have been going up. Cost of buying a house has gone up in conjunction with prices. There was one more thing in here. Economy looks fairly healthy outside of housing. Obviously, right now, employment is at an all-time low and average wages are up. Okay, so that was 2006, before anybody really knew what was going to happen in 2007. Well, a couple people knew. One of the biggest indicators, and I don't know if I have this article up still or not. Maybe I do. This is an article from January of this year. The rare bear who called the crash warns housing is too hot again. When real estate investors get this confident, this guy gets nervous. Home prices surging to new records. Home builder stocks last year outperformed all other groups. And bears, in other words, people or stocks companies that people want to short, are very rare. So this was January, okay? Everybody's got high confidence in home builder stocks. He manages a pretty large portfolio, $1.3 billion of high net worth individuals. Predicted the crash before prices reached their peak. And his housing bubble bellwether barometer of home builder and mortgage company stocks, which jumped 80% in the past year, is once again flashing red. 2005 all over again, with the valuation extreme, psychological excess, and the denial. People don't believe housing is in a bubble and don't want to hear talk about prices being a little bit bubblish. So this is prior to spring market that he's writing this. This is kind of a counter argument to his argument. Says obviously, and this is what everybody talks about. The reasons to be optimistic: the demand, millennials aging into home ownership, baby boomers getting ready for retirement, expected to fuel demand for years to come if employment remains strong. Sales in master plan communities, 55 and over communities reached a record last year, and confidence from the National Association of Home Builders rose to the highest level in 18 years, as starts of single-family homes in November were the strongest in a decade. Now, here's the thing about home builders, okay? From the time a home builder buys the land to the time there's a house for sale can be 2 to 3 years. They've got to develop the land, they've got to get permits, they've got planning, infrastructure, that all has to go in place. So understanding that nobody can time the market, what happens if a home builder buys land and starts development on and starts building in something and is invested in that project at the time the market is turning?
lately.
What happens?
Because I'm paying more than it's going to be worth by the time it closes, probably.
Yeah, paying more than it's worth, paying too high. But what really happens is builders overbuild, and they don't really know it until the market shows them, and they're already they can't plan their timeline. It's not like a flip investor that's time horizon is 60 to 90 days to get their money out. Home builders' timeline to get their money out is 2 to 3 years. So by the time they've overbuilt, it's too late. They can't correct that, and they don't know. They're completely speculating. Time this article was written, as soon as homes are finished, they're flying off the shelf. Home builders, this is interesting, which is focused on pricier homes since the market bottomed out in 2012, are getting ready for a wave of first-time buyers left with little to choose from with the existing home market. Investors are rushing to builders of starter homes because lower-priced homes in the U.S. are in short supply. Overall, the S&P's 500 index of home builders increased 75% last year, about 4 times as much as the market at whole. Some of these stocks are up 1,000%. This isn't in here, but some of these stocks are up 1,000% since the bottom of the market. All right. So this guy's Stack's opinion. The market might gradually correct itself. History shows that it's more likely to come down hard with the next recession, he said. He described the pattern as a steep run-up in housing, and this is true. If you look back on the last 50 years of housing cycles, it's always a gradual rise up, and then the fall happens very quickly, and then it takes a long time to climb out of it. Stays at the bottom kind of for a while. Last downturn came when economic growth slowed after a series of rate increases, exposing the rot in the woodwork, prompting loan defaults. He noted that the Fed has projected 3 rate increases for this year, said that this raises the risk that today's highly inflated housing market will again end badly. He's watching home builder stocks closely because they're a leading indicator, peaking in 2005, the year he called the crash, and the year before home prices themselves hit a top. Stack has been studying median home prices too, which typically track long-term inflation measured by Consumer Price Index. Last summer, they were as high as 32% above the measure. In 2006, just before the housing bust, values were about 35% higher, according to data from the NAR. So, if we see mortgage rates at more historical levels, house prices can't stay where they're at. Rate rise, we know this, from 4 to 5% for a 30-year loan, drive up monthly mortgage costs by 12%. On top of the annual median price gain, 7% for existing homes in November, which is November of 2017. Meanwhile, disposable income, or earnings adjusted for taxes and inflation, increased just 1.9%. All right. Then there's some counter arguments there. All right. Now, oh crap, did I get out of that? I want to look at the article I had, which shows what's happened to home builder stocks recently. So this article was written in May, and in news headlines in last week that I saw, the home builder stocks were all still down. They were continuing to fall. We can look at those on an individual basis, but this was again in May. The S&P's home building index, which only has 3 constituents, Lennar, D.R. Horton, and Pulte, is down 15% so far this year, compared with a 1.7% gain for the broader market. Home building index peaked in January and is down 20% since then. Broader home builder index, which includes home improvement retailers such as Home Depot, is down about 10% to date. So, why are the home builder stocks and the home improvement stocks down? Why do you think? It's pretty simple. They're down because they've overbuilt in a high supply sector of the market. Mm-hmm. They cannot build affordable housing. That's where the demand is. All this demand, quote unquote, that's in the market is in affordable housing. It's not in 500 and up. It's not in luxury. The scales tip. We can look here at the TAR report. You can see on a area by area basis in Wake County. This is the supply column. So the scales inside the Beltline tip at about 800. Obviously, prices are a balanced market is about 4 months supply. So let me blow this up so you can see a little better. 4 months supply is pretty balanced. So it's almost balanced as low as 600. The supply outweighs the demand when you get into 800 with 6 months supply. That's inside the Beltline. Cary and Morrisville happens at 600,000. Apex, Holly Springs, it happens at 500,000. South Wake, Fuquay happens at 400,000 and pretty close at the $300,000 mark. That's pretty close to balance. And then you look at 200 to 299, there's 1 month supply. So that's where the demand is. It's in these affordable house. It's in the down here, South Raleigh, Garner. You jump from 1 month supply from 2 to 299 to 7 months supply once you get to 300. Down here, Knightdale, Zebulon gets a 3 month supply in the 300 to 399, and then you jump to 11 months supply in 4 to 500. That's all the new construction that's happening in that area. They've overbuilt. 7 months supply, Northeast Raleigh, when you get to 400, and a 4 month supply in 300. And then you jump down here, 0 to 300, 0 and 1 month supply. I mean, Wake Forest, Roseville, balanced at 400, almost balanced at 300, oversupplied 500 and up. I mean, you got a $500,000 house to sell in Wake Forest that's a resale. Good luck. 3 month supply in Midtown. This is Northwest Raleigh. This is like North Hills area. Jumps to 6 months supply in 600. But why do you think there's so much supply in these higher price points? Is it because demand has shrunk? I don't think so. I think demand for those price points has stayed steady. I think a lot of people that own a home in that price point, in those price ranges, are trying to sell. They don't have to sell. They're testing the market. So there's all this supply, but these are people that I think can afford their monthly payments, don't necessarily have to sell. They're putting their house on the market. If they don't get their price, they won't sell it. So that combined with all the new construction being in a higher price point because A, land is more expensive, building costs are rising, regulation costs are as high as they've ever been. Government regulation on on home builders is putting astronomical expense on the home builders. So they can't really build anything worth a damn under 400,000. So what's happening is they're all building in that price point. Resales are rampant in that price point. There's nothing for sale under 300,000, like really, you know, as it compares to demand, and that's where all the demand is. If you look at a price point graph that shows you where the buyers are, I mean, like 90% of the buyers are in that sub 250 price point, and then it falls off. That's where all the affordability is, and that's where none of the houses are. So how does this issue turn into a slowdown, potential crash when unemployment is still low. Still very low, and income is up. What has to happen? Throw something out.
The builders are they letting go? Do they start letting go of these properties then, or selling for cheaper?
Mm-hmm.
Which then starts affecting the value of other loans,
Mm-hmm.
right?
Right. Yeah, so you're right on. So a couple of things that have happened that I think are going to impact this next shift that I don't think anybody's really talking about. And again, I could be completely wrong. Everybody seems to think, including Gary Keller, thinks we've got 2 more years of steady increases in prices. When the market crashed, anybody with cash was investing in real estate, buying up homes. Distressed inventory, you saw American Homes for Rent, companies like that just came in and put out thousands of offers and snapped up anything that fit their portfolio. And they've continued to do that and are starting to kind of slow down now. They're investing in real estate because they could buy it on the cheap, rents were still high, and that rate of return worked for them. What I think is going to happen is as prices in these lower price points start to climb, so let's just take, for example, where did I see? Okay, let's just take this, for example, Northeast Raleigh. From 3 to 399, 4 month supply. You jump up to 400, you've got 7 month supply. So all of a sudden, you're in a buyer's market. So if you can buy, if you're fighting for a house, or even let's just take this, 200 to 299, 1 month supply, and then you jump to 300, and it's all of a sudden a balanced market. If you got to fight people to buy a house at 250, but at 300. You can get more house for your money and be in a more balanced market. Why would you not? So the market is squeezing. Prices in the lower price points are going up, and then the supply outpacing demand in the higher price points is forcing prices to either level off or slightly dip. And so the highs are getting lower, the lows are getting higher, and eventually, if you spend $5 extra, you get twice the house, right? That doesn't make any sense. So as prices in those lower price points start to level off at all-time highs, I think the institutional investors are going to start dumping their properties as they realize that they're no longer getting the rate of return that they could, and they take advantage of their capital gains, and they move on to something else. Because what's also happening is interest rates are rising, which means that other investment products are going to become more attractive. National debt is still rising, which means the government has to pay debt service on that. The only way they can do that is to raise rates. So rates are going to continue to rise. I think a lot of these institutional investors will start to dump their properties in those lower price points, which is going to put an influx in the supply market. I think private investors will start to follow suit if prices start to drop a little bit. Now all of a sudden you're going to have a ton of supply. At the same time, I think demand is going to go down because just all you have to do is drive through downtown and North Raleigh, and you've got one apartment complex after the next, right? So rental rates are going to start to fall as the supply and rental properties goes up. So as prices remain high and rent rates start to drop, I think these institutional investors will start to move on and get out of these homes. And it's all a cycle. It all happens. So it has to happen that this is going to come down. It can't go up forever, right? Let's see. I'm looking at my notes here. Oh yeah, so what's going to happen to the higher price points, if that does happen, is all of the people that are the kind of don't have to sell people are going to get out of the market, and it's only going to leave the have to sell people, which is going to decrease the supply. If demand stays the same and steady in that price point, which it probably will, then that's going to start to balance out the higher price points. and that squeeze will soften a little bit. Yeah, so that's kind of what I see happening. I don't know if that's going to happen in 6 months, 12 months, but you start to see home builder stocks decrease, which is the same thing they saw before the crash in 2007. And you start to see home prices rise and rates rise in the lower price points where there's no inventory. Meanwhile, the higher price points have a surplus. It's going to force the prices in the lower, in the affordable range back down. And then if institutional investors get out of their assets, it's going to put more supply in that section of the market. I just want you to be aware of this because you need to kind of know where the market's heading. I think that if you listen to the conventional wisdom and even people talking around here and even what you hear, in the news, like that article said, nobody wants to talk about a bubble. I'd say Keller Williams has been talking about a shift for, a couple of years. It hasn't happened yet. But I think, when I talk to people that are in the market, I'm telling them to get out. If they're in that 250, 300, I'm telling them get out now because once prices start to fall, it's too late. Once prices start to fall, the struggle that people have is if you're in a depreciating market and here's today and you're going to be in the market in 2 to 3 weeks, then you don't price it here. You actually have to price it here to sell. So you have to price it for less than the market says. So now we're going like this, where you can price it here, you can price it here, and you'll still be all right. But when you have a falling market, people don't price their house appropriately. So then the inventory sits, and the only people that sell are the ones that are willing to price it into the market. And that's a really hard shift to get people to think about when you've been in a 7-year climb. So the people that are going to make out right now in today's market are the people that have a house in the 300s or the 200s that want to move into the 500s. They should do it now. They're silly to wait. I'm seeing sellers get greedy, wait, thinking the market's going to continue to go up, which everybody seems to think it will, and they're going to get caught with their pants down and wish they sold. I talked to 6 people yesterday that are seller leads that I've had in my pipeline, and every single one of them, I was so frustrated yesterday. They're all waiting. I've got one guy who bought a house from a family member at $100,000 in Raleigh, and if he sold it today, he could make $80,000 without putting a dime into it. He wants to wait because he thinks he can make more money. I'm seeing people make really, really dumb decisions financially, and you can't talk sense into them because everybody knows prices are going to rise. Just like in 2005 and 6, everybody knew real estate was the safe investment.
What do you say? There are buyers, though, that are getting afraid of buying because they think things are going to go down.
That's where you have to talk about interest rates. You have to talk about interest rates are going to go up. They have to. They have to go up. Unemployment low, income high, national debt soaring. There's no other. The rates have to rise. Every economic factor points to rates rising. There's no reason right now economically to keep rates low. There's no reason. And so buyers who want to buy and get into a house long term, if their timeline's 10, 15 years, they're going to be fine. As long as they don't want to buy a house and sell it in 3 years, ride out the storm, get an interest rate while it's still low, historically, but there's no doubt going to be some changes. I don't know if it's going to be a steep fall. Everybody seems to think it's going to be a leveling off or a pullback or a gully or whatever you want to call it, but if you look at historical trends, that typically isn't the case. Usually it's a steep drop. So,
what did you say
your best bet right now, if you want to look out 12, 24 months at your business, your best bet is start to develop a pipeline of investors with cash. All those investors that have come in over the last 12, 24 months that you haven't paid any attention to, those are the people to focus on. Because when real estate prices dip, and you don't have any buyers that want to buy because they're all scared, which is going to happen, you're either going to live or you're going to die on your investors. And if you have an investor pipeline, it's going to change. Instead of what's happening now, which is buyers telling you, hey, I want to see this home, hey, I want to see that home, hey, show me this home and then buy it. It's going to turn into you guys scouring the internet, learning what a good investment looks like financially, and pitching it to your portfolio of investors, and that's how you're going to sell. If the real estate market crashes again, that's what it's going to be, and that's what it's going to look like in the buyer market, because only people with education, numbers-based, return-based people with cash are going to buy. Everybody else follows the conventional wisdom, like we're seeing now. The reason that people don't get ahead in this country is because everybody wants to sell low and buy high, when the opposite is true. You want to buy low and sell high. When there's blood in the streets, buy real estate. That's an old saying, meaning when nobody else is buying, that's the smart time to buy. But nobody else is buying, and that's your client base. And getting them to jump into a market that's got all the bad all the bad news headlines, right? Nobody wants to buy when the real estate market is crashing, but that's the time to buy. So, anyways, my 2 cents. I think it's happening right now. I could be completely wrong, but I'd rather be early to the party than late.
And you don't think, in our area with so many people moving in, that's going to...
All I can tell you is that's what everybody said in 2007. Triangle market would never be affected. University system, RTP, blah, 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 blah. But it was. Now, we didn't get hit as hard as some other areas. But, again, there are people moving here. But there's also so much development, apartments being built. There's a place to put them. And if the headlines nationally start to turn negative, those people are probably going to rent. Especially as there is no affordable housing. They can't buy. So I think we're insulated to some extent, but I don't think we're completely insulated. And if there's no other reason other than the fact that what goes up must come down, this cannot continue forever. It won't. So we may not know what's going to cause it, what's going to spark it, but people have short memories. And if you look backwards at history always repeats itself. Cycles always correct. So we may not be able to pinpoint exactly what it is. I think what I just talked about is one possible scenario of many, but you got to start insulating your business from it. So.
Okay, it's 11:05. We got that.
Okay.
Cool.